Hi, everybody. This is intended to be a tutorial of Holistiplan's Roth Explainer feature. You'll notice I've already navigated to one of these sample households within the Holistiplan universe. To access the Roth Explainer, first we have to go to the Roth conversion worksheet, which is available in scenario analysis by clicking on the pencil icon here in the Roth conversion row. Notice that I don't have anything in here right now. When I enter an amount for the Roth conversion for taxpayer 1 or taxpayer 2 or both, that will pop up a purple button that says New Roth Explainer. I'm going to click on that. And when I do, I'm going to take myself to a new screen. The first time you come to this screen within any scenario, you're going to get this setup wizard. It says, welcome to the Roth Explainer. To build out the projection of the Roth conversion as a benefit, we need to collect some information, and the first handful of screens will guide you through what we need. So go ahead and click Start. Notice that when we come to the first screen, it's already pre-filled. Right, it's carrying forward the information from scenario analysis. So in this case, we said that taxpayer 1, or Robert retiree, is going to do a conversion of $25,000, and the total tax cost of that conversion was $4,013. That's right here in the Roth conversion worksheet. There's our $25,000 conversion, and Holistiplan has already calculated that the cost of that conversion at the federal level is $4,013. We get that amount by running the tax calculation both with and without the conversion, and the difference between those two is going to be the cost of the conversion itself. So that will come pre-filled. You can't change it in here. If you ever want to change the amount of the conversion for new scenarios, you have to go back to scenario analysis to do it. Next screen will be for you to enter some asset information for your clients. So this will be taxable assets, tax-deferred assets, and any Roth assets. So taxable assets, you'll always see when we start out, there'll be zeros across all these boxes. The total amount for taxable assets must, at a minimum, exceed the cost of the conversion. That's because the way that the projection is put together, we don't have the ability for folks to pay for the cost of the conversion by additional withholding from an IRA. So you have to have at least something outside to pay the taxes. In this case, we'll give these folks $150,000 of taxable assets. We also ask for the cost basis of those assets because we'll be doing tax calculations all the way through along this projection. So anything coming out of the taxable assets that might be considered a gain will be taxed accordingly. So in this case, we'll give them a cost basis of $100,000 for everything that is in their taxable assets category. Then the tax deferred assets for both folks in the household. So in this case, we need to, at a minimum, say that the IRA account size itself has to be larger than the conversion amount. So we'll say that Robert has $500,000 of tax deferred assets, and then the spouse has $250,000 of tax deferred assets. And in this case, we'll say that maybe they have, I don't know, $20,000 of a Roth IRA already pre-existing. Since this is a longer term projection, we have to have some sort of estimate of a rate of return. The 8% is not based on anything. This is just a number to have in here. So go ahead and put in whatever number you think is appropriate for your particular clients. For these folks, I'll just make the assumption that they're relatively conservatively allocated, relative to history at least, and have a 5% rate of return. The portion of returns that are capital gains, this is to adjust for the fact that as assets grow, at least on the taxable side, some portion of that growth might be appreciation, right? Capital gains, and some of it might be from dividends and interest. So if we think that all of our gain, all of our return on our taxable assets will be because of capital gains, we'd put 100%. Now, the difference between 100% and 0% would be 100% of our gains being capital gains means that they're not taxed every year, right? They're only taxed as money would come out. If we assume that some portion of the returns are because of dividends and interest, well, that would be taxed in the current year. So let's say we thought that most of our returns were going to be capital gains. So we'd say maybe 80% of our gains were going to be due to just price appreciation, and the remaining 20% would be due to dividends that would be thrown off of our return here. That's all entered. That's all here in the text, but I wanted to highlight that as well. What else? Well, how long are our folks going to live? So for Robert, and again, these are defaulted, these are not actuarial. We just start at 100. You can put in whatever you think is the appropriate life expectancy. Let's say we're going to scale back Robert's life expectancy to 95. We also, because we're trying to model how much spending is going on inside here, we have to know what other sources of income might be coming in. So in this particular case, we've got Social Security. First year of the projection is 2022. We assume that Robert is already assuming Social Security. Just need to put in the amount in today's dollars. So let's say it's $30,000. Notice that this isn't flowing in from scenario analysis. So for right now, you just have to enter this amount here. It's not going to bring over from scenario analysis, whatever the Social Security benefits are. We do the same for Roxanne. Let's say she also lives till 95. She hasn't yet started taking Social Security. She's 67, so we'll say that her first projected year is 2024, and that she will be bringing in an additional $20,000. What else do we need to know? Well, how much spending are they doing? We'll put this in today's dollars. This is after taxes. We will do inflation adjustments over time, which is this number down here. Let's say we think that inflation will be, they're going to spend $75,000 after taxes, and that we think inflation will run about 3% per year. We can enter that as well. The last screen on here, this is totally optional. You do not need to do this. But some folks like to see the value of tax deferred accounts as if they were after tax equivalents. What does that mean? Well, right now, anybody's IRA has an embedded tax liability in it, right? The government already has a claim on some portion of your IRA. So to make this an apples to apples comparisons between tax deferred and taxable accounts, sometimes folks want to see the tax deferred accounts as if they were after tax equivalents. The way that you do that is we just assume some rate in here that would be the embedded tax liability. This is not the tax rate that you pay in every year of the scenario. This is just a visual adjustment for the tax deferred account so that it makes it look as if it is an after tax equivalent. If you don't want to do this, you don't have to do anything. If you do want to do this, you just have to toggle this on and then put in the appropriate amount that you think you want your tax deferred accounts adjusted by, so that visually they look like an after tax account. But again, you don't have to do this. You can just leave this alone. You can also assume that the 2026 rates sunset. So that would be the way things are currently scheduled to happen. The Tax Cuts and Jobs Act is scheduled to sunset in 2026. If you leave this as is, the assumption is that we reset to the way things were in 2017 with all of the underlying brackets and all those rules, but everything adjusted forward for inflation. If you would rather not see that and just want to assume that whatever is happening today is going to happen indefinitely, you can turn the sunset off as well. I'm going to leave it on. And that completes things. That's going to then take us to a few screens on here. So it's explaining, similar to our other explainers, what a Roth conversion is. So talking about how tax deferred accounts have a hidden liability, how the benefits of conversion could be to separate that liability out now, pay it now, and so that every dollar of growth from here on out would not be taxed. Important point here, and we highlight this, the illustration here is assuming a hypothetical situation of converting all tax deferred assets. Now, that's probably not going to happen in most folks. This is really just to illustrate what is the benefit of a Roth conversion. Again, to pay some of the taxes now for tax-free growth later. But to look at the specific case for your clients, you can scroll down to the Roth Conversion Evaluator. You'll see two colored lines. The light teal line is the base case. That's a no conversion case. The dark blue line is the Roth conversion case. And what you're looking at is the value of the portfolio all along the way, starting from our current year all the way through the end of our scenario. In some cases, it's not going to look like there's too much of a difference because of the granularity here, or the lack of granularity here. So you can toggle to show just the last 5 years. And when you do that, you'll see that even though the portfolio values are declining, the Roth conversion after some point does make sense, right? So we've got more portfolio value in the Roth compared to the non-Roth case. Down below, we've got a graph that highlights that a little bit better, right? So here we're seeing total portfolio values. The difference section of here is saying at what point does the Roth conversion scenario look better than the no conversion scenario? So every negative number here is when the no conversion scenario portfolio value is higher than the conversion value. We hit a crossover point here in this particular case, right around 2040, 2041. And then from every year on out, the Roth conversion portfolio value is better than the non-conversion value. All of the assumptions are listed in the table down here. You can have any disclaimers that you want. On the right-hand side, we've got a control panel. So if you want to edit a few things after you've run your initial scenario, you can. So if we open up the control panel, you can show and hide specific sections. You can change the amount of the assets cost basis for any of these items. You can't change the amount of the conversion. Again, you have to do that from scenario analysis itself. If you wanted to change your rate of return or the rate of inflation or the portion of returns that are capital gains, you can do all that in here. You can change life expectancy for either client. You can also come in here and change the Social Security amounts. So maybe we were wrong, or maybe we want to model it something different. You can change spending. So hypothetically, let's say that we know that our clients are spending $75,000 per year right now, but that by the time we hit 2040, spending is going to go down to, I don't know, $70,000 because they're not traveling as much, right? You as the advisor get to manipulate all this. It's totally up to you. So what we would do here is we would say, okay, in 2040, spending is going to change from 75,000 to 70,000. Now notice here in the actual analysis, it says data's changed, you must reload. So if we click reload, everything will reload with this spending change. For those clients that are still working, you can enter their amount of wages right now. So let's say, I don't know, these folks were still working, it's 2022 and they were bringing in $15,000 because it's some sort of part-time job for somebody. And then in 2025, they were going to stop working entirely, right? So we'd say wages changed to zero. The point that I want to make here is that you are not entering the amount of the change in any of these columns and any of these fields. You're putting in the actual dollar amount. So spending changes would just be, okay, from 2022, this is how much they're spending. From 2040, they're spending $70,000 all the way until the end of the projection. Same thing is true down here with wages. So in wages, we say, yes, right now they are earning $15,000 a year, but that's going to stop entirely in 2025. So at that point on, I want wages to be zero. There isn't a section right now here for pensions. So some folks have asked about that, you know, how do we enter pensions? And for right now, the workaround is to just enter pensions as a wage. So let's say instead of these wages, and if, by the way, if you want to ever delete anything, you can go ahead and do that. You can hit the little trash can. Let's say that we wanted to simulate a pension of $15,000. Well, we do it exactly the same way. So we've got 2022, pension is going for $15,000. Let's say that that's just on one spouse, and that person's life expectancy, they are going to lose that pension. You could say, and I'm not going to be able to do the math, but let's say in 2040, the person who is claiming the pension dies and there is no survivor benefit, we could change it to zero at that point. And now we've modeled a pension with no survivor benefit. If there was a survivor benefit, you could keep it, you know, sometimes you have 100% joint and survivor. Let's say it was maybe 50% joint and survivor. You could do the same thing. So change the benefit to $7,500 in 2040. Go ahead and hit reload. And now we've got a new set of variables. Right now, everything looks a little bit different. The conversion actually looks a little bit better. Or I should say the total portfolio value looks a little bit better. Conversion still happens roughly the same time, but maybe a little bit more terminal value there on the Roth side. That's all there is to it. If you have any feedback on the Roth conversion explainer, please go ahead and let us know. If you ever have any questions, go ahead. Remember, you can always click support. We're happy to help you with whatever you might need. Thank you so much.